I think this is actually a pretty good opportunity to get involved in some of these Chinese names. Obviously, we've seen what's going on with the U.S. and Mexico trying to settle that trade dispute. And I think once we get to later this year, that'll also happen with China. So I think the fact that the CQQQs, which is the Chinese equivalent to the NASDAQ 100, is down 16% this year, and the fact that the triple Qs are up 18% this year, this really creates a pretty good opportunity in some of these high-quality names.
Yeah, you know, anytime you hit a milestone, as we did yesterday in the NASDAQ, inevitably you're going to get comparisons to our last highs or last milestones. You were there. You've been around a while. You were an analyst back then. I mean, is there anything in this market that is concerning to you from a valuation perspective, or anything that puts you in mind of other tops as we've seen them in the NASDAQ?
You know, I think that's a great question. I mean, I was an analyst, as you rightly pointed out, back in 2000. But valuations right now, they're incredibly reasonable. So when you look at that in the U.S., it's really hard to get concerned. You've got a Google that trades at 24 times earnings. It's growing the top line at 20%. You've got a Facebook in the low 20 PE ratio. You know, they're growing the top line over 30%. So it's really hard to say, you know, there's specific names that you can say, wow, you know, Netflix still has a PE ratio over 100. But in general, when you look at U.S. tech companies, they're still growing incredibly fast. They still have a lot of potential in front of them. And you actually can buy them at somewhat reasonable valuations because the earnings are growing so fast. So, you know, I think that looks good. You look at these Chinese names, you know, we have a basket of 7 of them. The top line is growing at 37% for these 7 names put together, and you've got a PE ratio of 27 times. You know, I'll take that all day long because if your PE is below your growth rate, that's a pretty good sign that you're getting some pretty decent value for your money. So I actually feel pretty good about things. And when you look at the economy, you've been talking about it all week. The economy is pretty strong, and once we get some of these trade issues sorted out, you know, it should get even better once we have, you know, good trade relationships with countries like China.
Dan, you were on in July with us, and we talked about China, and you said the companies that are affected are in hardware. That's why you like names like Google and Facebook. And you said that's important because if you think it's going to get worse, and I do think it's going to get worse, has your view changed on that, and has the thesis changed?
No, it really hasn't. I mean, we own one semiconductor stock. That's it. I mean, I'm a semiconductor analyst. So for us, you know, we've stuck to that because, as we've seen, you know, this thing with China is dragging on longer than we think. And if you think about where technology is sold, the number 1 PC market in the world, that's China. The number 1 smartphone market in the world, that's China. Automobiles, where a lot of semiconductor components are going into, that's also China. So for us, you know, until we get that sorted out, we want to stay out of hardware. The flip side of it is you look at Google, you look at an Amazon, you look at a Facebook, you know, the good news is they're locked out of China. They don't care what happens to China. So this tariff situation isn't a big deal for them. And likewise, for the Chinese internet companies, you know, again, they're internet companies domestic to China. They don't care about the tariff situation really either, other than how it's affecting the domestic Chinese economy or the currency. So that's why we're staying involved with the internet names. We're not in hardware, and, you know, we are, you know, still, well, like you pointed out, we're where we are back in July, where we still remain negative.
Dan, it's interesting to hear you talk about hardware because we've actually seen tech hardware stocks outperforming recently. So it's good to get your take on that. The other discussion we've been having repeatedly on our air is whether it makes more sense for investors to continue playing the growth stocks or whether there's value to be had and to start seeing a rotation into some of those more value names. It sounds like you're in the growth camp.
Well, I mean, so I'm in the camp of I want growth at a reasonable price. So when you look at it, the number 1, the biggest name that we have, you know, outside of Lumentum for 3D hardware, you know, 40% earnings growth, 16 PE. We like that. That's our favorite name. But you look at a Google, more well-known, obviously, and you're talking about a 24 multiple on 23% sales growth, 20% earnings growth. We like that a lot, too. Netflix, we were actually short that name into earnings. You know, we look at 100 times PE on 35% revenue growth. To me, that's not interesting value. So I'm definitely looking more defensively at the names that are there, but I'm very concerned about valuations in some of these, and I'd rather get paid with a low valuation and still good top-line growth. So that's why we're getting a little bit more defensive around that.
And Dan, finally, you mentioned Google or Alphabet. Any concern on your part as a holder there from this, given this tweet from the president criticizing the search results not reflecting enough of a conservative viewpoint for certain terms?
No, I mean, that doesn't bother me. I mean, I think actually with Google, this is probably the best I've felt on Google in several years. Because when you look at Google, they've really had a problem with the fact that they paid out a lot of money for being the default search engine, for example, on Apple. And so that number has gone up quite a bit over the course of the last 3 years. It was, in fact, up over 60% in terms of paid to other websites in March. That's actually starting to come down. So that got into the 40s. That should continue to come down. And so for the first time in a long time, if you look at last quarter, they beat revenues and earnings for the first time in 3 quarters. I think you're going to see that be a trend going forward where the top line is now augmented by the bottom line also being strong as these expenses start to get smaller. So that's one of the reasons we like that name quite a bit.